please stick around for this one because we have Kash Razzaghi, Chief Commercial Officer at Circle, and Ronit Ghose, Global Head Future of Finance at Citi. Please stick around because this one's all about the institutional bridge, how banks and digital asset infrastructure are converging. Okay, folks, let's welcome them on stage. Come on, big round of applause, please.
Right.
Hello.
Hello, everybody. So, it's the afternoon, final day, so we're going to try to keep you awake, right, Kash?
We're going to do it. We're going to try.
We're going to try to keep you awake. We're going to be talking about the institutional bridge, stablecoins and regulated stablecoins, and banks and FI. Kash and I were on stage several times, actually, in January in Davos, and we just published a bunch of big reports on this topic. And the reason we've done a lot of work on this topic at Citi, and I run a think tank for Citi and a client engagement unit called Future Finance, an advisory unit, is that since late 2024, it was clear in the US that we had this regulatory sea change that allowed regulated FIs like ourselves to begin to engage, or in some cases re-engage, with digital assets, with crypto. Where are we in that journey, Kash? How much further have we moved along since January 25 and January 2026? I guess if we'd met in January 25, we'd be talking about it's theoretical, because in 2024, most banks sort of looked at you and go, not really sure if we can engage with public blockchains.
Yeah.
And that began to change dramatically. And are we past theory? Is it practice now? Are the big FIs in Europe and the US saying, let's work together, or is it still innovation theater?
Yeah, let me actually go back before 2025.
Ooh, how far back are you going to go?
So I joined Circle 6 years ago, in the height of COVID. And we would go to these conferences. We would go to conferences around the world, Money 2020, et cetera. And we would try to have conversations with FIs, banks, institutions, and they wouldn't meet with anyone, right? Every bank, every financial institution at that time in 2020, 2021, 2022, they may have had an innovation team, or they may have had a few people poking around to see what this crazy crypto stuff is.
Right.
But they wouldn't meet with anyone. And as the years have gone on, and certainly once the Genius Act passed, it was like a light switch.
Yeah.
It went from, we'll invest and only try to learn, to, okay, am I already behind?
Yeah.
And so I would say since last year, when the Genius Act passed, the kind of engagement that we've had from banks and from FIs has been a whole lot less about theoretical and abstraction, and more about, all right, how do we actually leverage this technology, and can we start really putting into use these use cases that can help us with our customers? That's been really inspiring to see.
And so in this first few years, would you even get into the bank, or would you be shown around the side entrance to the innovation lab? Or, I mean, I know we had Jeremy Allaire, that is, many years ago, and that was an interesting conversation. Let's just put it that way. Many of the bankers in the room were, deeply skeptical.
It felt like it was very binary at these institutions. You either had people that really believed and felt like this was the future, and those people probably seemed very crazy to the non-believers. And the non-believers were the executives who had obviously built their careers off a certain way of doing things. And so we saw that stark difference between people that were really interested but couldn't do anything institutionally. They couldn't get others bought in. And as the years went off, I think regulation was one piece of it, but as you started to see more products, more companies, and better education, now I think we're at a point where these institutions, to the point you made, are really thinking about how do we use this to advance our business.
Yeah. Now, I think there was maybe three things that happened. I mean, obviously the big one is regulation, because If the regulators say you can't touch it, then you can't touch it. But there's two other things that happened. One was the clients. So the banks, or what I call the sell side, they're pretty straightforward institutions. If it's legal, if it's not illegal, and your clients want to do it, they'll do it. And what began to happen is that even before the laws began to change, even before the Genius Act, we kept getting people knocking on our doors, the buy side, the asset managers, particularly in the US, knocking on our doors going, we want to do this. We want to put assets on chain. It's not just we want to put, sell Bitcoin or ETH or Solana. We want to put our existing assets on chain. So that was one big change. And the other one is the education piece. I think we're on probably our fourth generation of blockchain teams internally now. Because I still meet people at conferences like this and they go, hey, I worked at Citi doing blockchain. And I'm like, which year? And they'll be like 2015.
Right.
I mean, it's been going on for ages. I mean, we've been in research looking at it for about 10 years. But now that the banks, both in the US and Europe, are much more willing to partner, could you give us some examples, whether it's banks or other FIs or fintechs or maybe even, I don't know, sports clubs? Give us some examples, some live examples of partnerships that are working, that are out there in the wild.
Sure. I'll answer that question. I'll lead into it with why hasn't there been adoption, but I'll lead into your question. I would say there's another aspect as to why there hasn't been adoption. Regulation is great, but I would venture also to say that the technology has not been easy to use. So I'm sure everyone here is using AI. Every company in here is probably standardized some use of AI. AI is not regulated. And the adoption rate of AI, both at the retail level and at the institutional level, is through the roof. So you have to ask yourself why. Well, because those tools are much easier to use. Crypto and blockchain technology hasn't gotten to the point where it's abstracted away in the background and it just works. And so now the kind of use cases where partners are very excited about are the ones that are easy to see. So if you are a multinational corporation, you're an enterprise that you have to manage a sophisticated treasury geographically. Treasury management is a very easy use case for you to understand. Now I can move money from New York to Singapore on a Friday night. That's very easy for you to understand. Or if you're a business that has a very sophisticated payment model where you're paying vendors and contractors all over the world and you have to go in and out of different currencies using different payment rails, that's something that's also easy for you to understand. One of the challenges has been, because this is currency, you need a network effect. You need both people that are willing to send it and people that are willing to receive it. And so we're building that out, but these kinds of partnerships that we have today are really focused on the smaller use cases where they can see it work, the aha moment for these executives, and then we build on that.
You've recently launched your own blockchain. This has become a thing. Everyone's, in the last 12, 18 months, launching a blockchain. Why? Why do we need another blockchain? I mean, there are, I think, thousands of these already. So why do we need ARC? I mean, we know what Jeremy says about the economic operating system, but tell us, for the audience in the room, what does it solve that existing chains don't?
Sure. We grappled with this significantly at Circle over the course of the last year or so. And in fact, USDC is native on over 30 blockchains today. We have incredible partnerships with the leading blockchains in the world, and we work with them. When we take a step back and you think about that very question, now that there's regulation and we believe that the future economy is on-chain, well, what will it take for large institutions that are in this business, that are handling trillions of dollars of payment volume in custody? What will it take for them to come on chain, and how come they haven't yet? Well, there's several important pieces here. Number one is most of the activity on chain, I don't think this is controversial to say, most of the activity on chain has happened in DeFi. It hasn't happened yet at an enterprise scale. And so why is that? Well, first is, who are the validators? Are these validators that are responsible for the activity on the chain, are they reputable validators, and can I understand how they're doing things, and is there a governance model around that? That's one piece. Another piece is, gas fees and gas tokens. Do I have to now hold a token that is native to a chain that fluctuates in value? And from an accounting perspective, how do I think about that? That's another aspect here. And the third aspect is I want to issue a token. I want to issue either a stablecoin or a real-world asset or a tokenized deposit. I want to be in the business of issuing assets. But am I going to issue it on 30 different chains or 50 different chains? How do I know what works? Well, at Circle, one of the pieces of innovation that we have is a piece of technology called cross-chain transfer protocol. And that enables today USDC to seamlessly move across 30 plus blockchains, where you abstract away that complexity of moving from chain to chain. Now an asset issuer can come to Arc and issue a token, and now because of CCTP, that'll be enabled across different chains around the world. So now you issue once and you can be on multiple chains. So when you start to add these things up, native gas fees in USDC, not a native token, a validator set of the biggest institutions in the world with trust and compliance and interoperability. And then the last thing I would say is even definitive in finality, having sure that the settlement is happening in sub-seconds, not minutes. When you add all of these things up, we believe that there's an opportunity to really bring on a chain that can appease what institutions need.
So you're arguing that actually you're helping the interoperability problem, or you're reducing fragmentation, because when I see people announcing yet another chain, whether good or bad, my sort of instinct is, oh my gosh, we're getting more fragmentation. That's the last thing we need. But you're saying that Arc will actually help reduce fragmentation.
That's the ethos that we're building upon. Circle has always had the perspective that we want to be market neutral. Interoperability is core to everything that we do at Circle. And so this idea that, yes, there are hundreds or thousands of chains, we don't believe that there's going to be such a dramatic consolidation anytime soon. And so you're an asset issuer. How do you reach your audience, and how do you know which one to pick? Part of the appeal of what we're building with Arc is that with CCTP, you can issue assets that are now interoperable with other blockchains.
What's the future architecture look like of blockchains? Are we going to have more blockchains, less blockchains? I'm not asking for a dollar number forecast that'll get your CFO worried or your IR worried. Just conceptually, if you're sitting here again at this conference in a couple of years' time, because everyone seems to be, at least last year, existing technology companies, Google launched a chain. I haven't heard much about it recently, but it just seemed to be the thing to do last year.
I think until there is a 70% market share winner, where typically these network effects happen and there's a 70% winner, social networks and operating systems, et cetera. They're racing to this figure. And it's usually once there's a 70% winner, then people decide, well, all right, maybe it's not worth building here anymore because it's hard for any differentiation to happen. I think the reason you're seeing so many companies build blockchains is because they see this green field of opportunity with institutional adoption. The institutions are not here yet, and they haven't moved to blockchains yet. And so you ask yourself, why? And so can I come in and differentiate my technology in such a way to actually compete here? Once that happens, once there is institutional adoption, and then you start to see the 70% winners, my guess is that there will be fewer blockchains that are attempting to build here. And you're somewhat seeing this with stablecoins, right? I can liken it to what we're seeing with stablecoin issuers. There's not yet mainstream adoption, and so businesses around the world are considering launching their own stablecoin because maybe there's a piece of that pie that they can get. But again, once the network effects have been built, differentiation is going to be harder to come by, and then distribution is very, very challenging.
Kash, you spent, I think, almost the last week in Europe, or I'm including the UK in Europe for the purposes of this conversation. You spent the last week in Europe and the UK. How different do you find your conversations with clients as Chief Commercial Officer in this time zone versus when you're back home in the US? What are the big differences and similarities?
Well, in many ways, the region, I'll talk about Europe as
Sure.
a region, the region is very sophisticated, more sophisticated than many of the institutions elsewhere. When MiCA passed, there was a reason it passed, because there was demand. There was commercial demand for this technology. So MiCA enabled Circle to really operate in a region where there's an audience that understands this technology, that understands the benefits of the technology. And so the kinds of discussions that we have with institutions here is really against business value. It's less about what should my stablecoin strategy be or what should my blockchain strategy be. And it's way more about what is my business going to look like in 5 years, and how do I compete, and how do I build new revenue streams, and can this technology help me do that? And so there's less of, let me tell you what a stablecoin is, and let me tell you what a blockchain is, and much more about how do you implement it and create that interoperability to allow you to build a new business ROI.
And so the conversations are pretty similar, you're saying, on both sides of the Atlantic.
I would say Europe is a little bit more advanced in their thinking simply because of the regulation that has happened.
Yeah.
The US and other places are catching up. Again, Genius Act put a spotlight on this.
Yeah.
And so as a whole, though, institutional adoption is still very, very early. And I don't think any bank or financial institution should worry that they're behind yet.
I know you mentioned a very good point about Europe, and actually some ways, and we don't say this enough, working for American institutions, but Europe has been in some ways ahead on public blockchains because the regulatory environment in the US for, at least under the previous leadership of the OCC and the Fed and other institutions, was pretty skeptical about public blockchains, if I say that politely. So, whereas in Europe, you did have the opportunity, including in France with the French banks, to experiment with public blockchains. Let's talk about currency. One of the reasons I've been arguing, even in the previous administration in the US, that stablecoins particularly, but digital assets, should be embraced by the US administration was, I was writing that this was pro-dollar. And then the Trump administration came along and agreed with that. But in the previous administration, it was seen as anti-dollar. And I was saying, no, this is pro-dollar because most, cryptocurrencies are, it's a native fiat leg is the dollar, and stablecoins are denominated in dollars. When you're having these conversations in Europe and the UK, does that currency point come up? Do they say, listen, we want to do euro stablecoins or British pound stablecoins, if that's such a thing as British pound stablecoins? I don't know.
There are some companies working on that.
Yeah.
I mean, there is certainly a tension, and I can recognize that tension if you are, in regions around the world where your own currency matters to you, and you want to make sure that there isn't a dollarization of the world.
Yeah.
Here's what I would say. The dollar is still the global reserve currency. The dollar is still used for 70% of global trading. And so they understand the necessity for the dollar and the value that it has for global trade for their country. But yes, I think you can expect to see many more fiat-backed stablecoins that are non-USD. I don't know on what time frame you'll start to see adoption at scale. Circle does have a euro-backed stablecoin, so we have the EURC. It is the largest euro-denominated stablecoin, but it's much smaller than USDC. But I agree with you. There is that tension. How do I think about this in a way where I can still participate in global trade, because that's how global trade is done, is in the dollar, but not to be susceptible to dollarization, so my own currency is challenged by that.
And it's natural that if you're in the Eurozone or you're in Japan or in India, your currency is sovereignty, and you're going to want to have your own currency. And actually, one of the things I've argued with a lot of our European clients, including public sector and government clients, is American institutions often want to issue in euros. So there's a demand from American, Japanese, Asian institutions to issue in another currency, just for, not because they're anti-dollar, just for diversification, balance sheet management purposes. So it'd be a good thing to have more euro-denominated, whether it's stablecoins or a digital wholesale euro. So I think the more we can get on that side, the better for the whole ecosystem.
Yeah, we're seeing new companies that are being built focused on different currencies around the world. And my expectation is, again, as regulation continues to happen worldwide, you'll see this propagate, and you'll have more currencies maybe than even blockchains.
Maybe just to wrap up, one final area of discussion. I just flew in, as you know, this morning from the West Coast, and the kind of word of the last 12 months or 18 months in California has been agents, agentic commerce, and I mean, maybe it's overhyped, I don't know, but we're definitely moving into a world where we're going to see more machine-to-machine transactions, online in particular. What's the role stablecoins will play in that world? Because I know your founder Jeremy has talked a lot about stablecoins being the ideal kind of payment token, but is that going to be a really big thing, or is it just kind of a hope?
I mean,
it sounds nice, but
it sounds nice.
Yeah.
I think it's not a leap though to say that stablecoins make transaction volume more seamless and the interaction of money better. It's faster, it's cheaper, it's more secure. So those are things that are qualities of stablecoin technology and blockchain technology. And it's also not a leap to say that once this does reach mass adoption, the total volume of transactions parabolically grows. So you can be 1,000,000x the amount of volume that we do today. Imagine that. And you add in agentic commerce, where agents are actually interacting with each other. We just actually launched a new product called Nano Payments that allows agents to make payments in fractions of a penny to one another. And so this is the kind of innovation that is actively happening, where agents are doing all of your purchasing on your behalf, and maybe you're not even in the flow yourself. Will that remove humans entirely? I don't know, but you can see that world where volume picks up because of these agents.
So in a couple of years' time, when my fridge is ordering for me when I'm traveling, like now, it'll be paying in USDC.
As long as it knows your preferences on the kind of food you like to eat.
Just need some milk in the fridge, that's all. So you think it'll be USDC. Kash, thank you so much for joining us.
All right, thank you very much.
Thank you.
Welcome to Signal Week.